Good morning. I'm Andy Myers at Weiss Research.
I'm Jen Amos, and this is your morning market alert for Friday, September 23rd. The global stock market rout that began on Wednesday is likely to continue today, despite a show of unity by the Group of 20 major economies. They pledged to work together to put an end to Europe's sovereign debt crisis. The unexpected statement promised strong actions to maintain financial stability, restore confidence, and support growth in the Eurozone. That helped to pull Asian stocks up from their worst levels of the day, and it gave a brief boost to U.S. futures. But that optimism didn't last long, as traders show that they're still concerned about the outlook for the global economy.
Investors are looking for more concrete action from the G20, along with the World Bank and International Monetary Fund, as they begin their annual meetings in Washington. In particular, the markets are hoping that officials speed up steps to implement the expanded powers for the European Rescue Fund they agreed to in July. Right now, the European Financial Stability Facility has 440 billion euros on hand to help bail out struggling nations. As the selling pressure and negative sentiment return to the equity markets, the US dollar continues its run against the euro. The shared currency is now trading well below $1.35. And the dollar's recent strength continues to weigh on commodities, including gold. The precious metal is dropping below $1,700 an ounce, and crude oil is falling another $2 today, all the way back to $78.50 a barrel.
Turning back to global equities, we're likely to see some of the biggest losses in the financial sector. A spokesman for the European Commission said they have no plans to speed up the recapitalization of 16 banks that came close to failing the recent stress tests. Most of those banks were in the PIGS nations of Portugal, Ireland, Italy, Greece, and Spain. And those stocks are taking a beating today. The Greek banks are getting hit especially hard after Moody's Investor Service downgraded the ratings of 8 institutions by 2 notches. But we're seeing losses across the financial industry, extending to the major U.S. institutions. Bank of America is set to open another 2% lower. It fell 7.5% on Wednesday, and 5% yesterday, after Moody's cut its credit ratings. Moody's also cut Citigroup's short-term rating, and that stock is tumbling another 3% this morning.
Turning to the technology sector, we may see some action in shares of Hewlett-Packard. After yesterday's closing bell, the company fired CEO Leo Apotheker and replaced him with former eBay chief executive Meg Whitman. Apotheker held the job for less than 11 months and had been under fire from the very beginning. Under his leadership, HP shares are down more than 45%, hitting a 6-year low last week. Whitman indicated that the company may still spin off or sell its personal computer business, a decision announced last month. But so far, the management shakeup doesn't seem to be doing much to change investors' opinion of the company. HP shares are dropping more than 2% in the pre-market. That's the latest from Weiss Research. We'll be back after the opening bell with all the market reaction.